Hello, everybody, and welcome to another episode of the Rodcast. Today, we have our quarterly investment mastermind, and I'm joined again by Manish Kataria and Adam Lawrence. If you are joining the investment mastermind for the first time, the idea is this is not investment advice, it's more a bit of fun. And what we do is every quarter we will pick a financial investment, whether it's a stock, bond, ETF, whatever it is, that we think is going to do well. And we'll go through the reasons why, and then we'll open up the floor for anyone to critique it. So, welcome, Manish. Welcome, Adam. I guess we should start because we are recording this on the 4th of April, um, sort of one day before really everyone's ISA allowance is up for the year, so people hopefully are pouring money into it. But also, it's sort of 1 or 2 days after we've had these Trump tariffs, and over the past sort of 24, 48 hours, we have seen stock markets really pull back, especially in America. So the S&P and Nasdaq have really kind of pulled back. What are your thoughts? Talk us through it. So should we start with you, Manish?
Yeah, so stock markets sort of pull the trigger first before, kind of before seeing the full details. And the stock markets, as Uncle Warren describes them perfectly, right? So the stock markets are a voting machine in the short term and a weighing machine in the long term. And really, what the markets are doing now is voting. People are voting. Will this turn into a recession? Will this cause inflation? So really, it's a question of trying to work out. It's a probability game. So right now, I guess the markets are pricing in some probability of a global recession, depending on how this thing escalates. And what I would say is that, look, if that worst case scenario happens, if there is a global recession, based on global escalation, I think we've got further to fall in that worst case scenario. I think personally, some of these will get watered down. I think Trump is, he's known for, this kind of sort of positioning. And, he wants to sort of scare his counterparties into believing he'll follow through. But the evidence shows otherwise. So I think right now, we really need to kind of wait to see how everyone else reacts and how this develops. We've not been here before, right? It's been 100 years or so before, since we've had a similar sort of exercise, and so we don't know how this will play out. And remember, final thing to say is this is one individual, right? This is one individual who's causing all of this, and a lot of this is self-inflicted. And if anything, the damage will be more on the US than the rest of the world. I think we in the rest of the world, in Europe, in Asia, we've got, probably a lot more sort of ammunition to deal with this than US manufacturers themselves, who are ironically the people who are meant to be benefiting from this. So I think it's a case of wait and see what happens.
Adam, any comment?
Well, I think that's interesting. I think it's one of those. It's one of those where it feels like it's in a academic sense, it's a great day to be alive. These are always interesting times. I was thinking as Manish was speaking there, it was reminding me of the 18-year property cycle for some reason, because we've got a 100-year tariff cycle apparently, as many 1828, 1933, etc. Never really worked in the past, has it? I must say, maybe it's just my brain works, but when I was listening on Liberation Day or whatever we're going to end up calling it in history, to the chat, and there was 10. Apparently, the UK is charging 10%. As I understand it, what really has happened is the trade surpluses have been used when it suits, as if those are tariffs.
It's the
And then
deficit, isn't it? So they've taken the deficit of one country, divided it by the total trade, and divided that by two for everything.
which is, but that still didn't necessarily stack up for the UK, I don't think. But nonetheless, that logic works some way down the list. I
Well,
think it works for Cambodia, but I'm not sure it
well,
works for
no, I
Cambodia.
think I think with I think everyone got a 10%, and actually, what they worked out is the UK doesn't have a deficit to the US. It's the other way
No.
around. So that's why they haven't gone any further. They've
So
just
that's why he just said 10%. Right. Okay, that makes sense. Because I must say, the way my brain worked, I just thought, well, we may as well now introduce the 20% tariff because we can have half price like everybody else, you know. So thanks for the permission, Donald. I'm not sure whether the right way to play him is to kind of troll him at his own Jack and Jill economics game or not, to be honest with you. But I mean, you know, joking aside, with Clara, you know, we all go on, people go on about, you know, UK manufacturing is dead, UK is all about services, blah, blah, blah. We've soon seen a pretty sharp reaction. Although, having said that, we obviously haven't seen the sort of reaction in the FTSE that we've seen in the global stock markets, aside from anything else. You know, pretty rough day yesterday. And the bond yields, on the bright side for those with a property focus, are on the way south, aren't they? I think the US are down about 40 basis points this week on their 10-year. Certainly, the 5-year gilt was hovering around 4%. And not saying I watch it obsessively, but I do look at least once a week, purely for the purposes of the supplement, of course, Rod. And it was down from about 4.31 at the weekend to 4.00 this morning. So there's been a fair old haircut on which means rates are coming down, of course, in the anticipation of a recession. But the argument then, and this is, you know, the classic thing about economics that used to make me chuckle and now makes me laugh out loud the older I get, is there's this big concept of ceteris paribus, the Latin phrase for all else remains equal. And of course, the funny bit about that is it's never the case that all else remains equal. So the yields are falling in the anticipation of a stronger probability of recession. But of course, if the tariffs were inflationary, then it would be harder to get interest rates down. But this is the tug of war that we've been in since 2021, where inflation, then the need to tackle inflation over trumped, if you'll pardon the use of the phrase, the need for low interest rates. And then the arm wrestle might just start going back the other way, certainly in the US. But of course, you can argue that tariffs for the US will be inflationary, but they could be disinflationary for the rest of the world. And then there's the comparative argument as well that, well, the EU tariffs are 20% and ours are 10%. So finally, Brexit's paying off or something, let alone how many points on GDP Brexit has cost us in the interim. Reasons to be cheerful, or should we just be being overall particularly miserable? It's a great day to be recording this, Rod. That's what I know. That's how I feel about it all.
a couple of points on that. So you mentioned the FTSE. Well, the FTSE 250's gone down quite a bit. It's got dropped by about almost 5% on this, which is interesting. And then my next point really was kind of just following on from what you said about although a recession, is that good for equities? Is it, because it comes down, if we do get a recession, are then the bond yields going to drop, and are we going to start seeing some positive news? It's that whole thing of the economy is not the stock market and vice versa. But like you said, it's hard to work out what is inflationary and what's not, and for who.
It's
Um,
also, you said before, will inflation just drop immediately? Probably not. So we could have a recession where 6 months worth was high inflation and contracting economy, which is particularly painful for people.
Manish, what are your thoughts?
Yeah, I mean, look, it's interestingly yesterday, REITs held up really well, and some REITs were actually up yesterday when everything else was selling off. So that reflects bond yields coming down. I, if you put yourself in the shoes of central bankers, right? You kind of look at this and you think, okay, well, look, I'm not going to take the risk of lowering rates because I don't know what's going to happen to inflation. Yes, there is a recession threat, but we didn't cause that. It was Trump who caused that. So, put all the blame on Trump. And as a central banker, okay, if you've got two mandates, which is growth and inflation, right? You've had your fingers burnt over the last 2 or 3 years. You almost let inflation get out of hand. And now, I don't think any of them would want to be taking on that risk, that legacy risk of kind of cutting rates during this unknown period of time. So I think they'll be quite cautious. I think, they won't go up. Interest rates won't go up. I don't think they're going to go down significantly. unless there is a really deep recession. And as you've just said, Rod, recessions aren't good for equities. Some more than the others, and it's especially bad for growth equity. So anyone who's been hiding in the S&P 500, in the Magnificent Seven stocks, and all of those things, any growthy type of sectors, stocks, including technology, including manufacturing, that won't do so well in a deep recession. That's for sure.
Before we get on to our picks today, I thought we might look back at a few of the picks that we've done previously. So one of them, which was a while ago now, maybe about a year ago, was Barclays, which was picked that has actually done really well over the past kind of year. But I mean, that's pulled back by about 8% over the last 24, 48 hours, which is a big drop, and arguably it's still priced in pretty well. So there are some stocks that, well, inevitably are gonna pull back with the rest of the market, where actually there may not be any underlying concerns. Now, that's not to say Barclays is one of those, but now I'm going to be really cocky here, because I'm going to look at our last picks for the last quarter, where we had Adam, you picked Wise, which is down 10%.
Well done, me. That doesn't sound very wise, does it?
But look, things don't go in a straight line, and what we're finding on this show is that picking them, we're all quite good at picking them. The issue is, when do you sell? And that's the key, because there's some that have done really well and then kind of fallen back down. And certainly for me, when I've kind of bought things, I've really enjoyed it as they go up, and I've kind of haven't really taken my winnings. So that seems to be a skill that I'm not so good at. Manish, you had Block, which has dropped a fair bit, which was the thing that followed Bitcoin.
Mm.
What are your thoughts on that now? Are you thinking, oh, that's actually quite priced in based on what's happening, or are you jumping back in now?
No,
Or
no.
what are your thoughts?
So when I picked Block, I think I remember saying at the time, this will either just go to the moon or it will completely collapse, right? Because it just follows crypto. It follows the crypto space. And because crypto's come off as it has, Bitcoin's down, I don't know, 25, 30% since that episode, probably. I'm not surprised. Block has just followed that, if not more. You see, I think you need to have a view on crypto. And, crypto, what we've seen over the last 3 or 4 months is, you see, a lot of people thought crypto is a place to hide, and it's like the sort of digital gold and, a safe haven and a store of value and all that. I mean, the last 3 months have just completely disproved that theory. And really, if you look at crypto, Bitcoin. I mean, I own a bit of Bitcoin, so that's fine. I think it's nothing wrong with owning a bit of it for the upside, but don't own it for kind of downside protection or a store of value. What we've seen, it essentially is a high beta tech stock, right? It just behaves like a volatile tech play, and that's all it is really. So, when markets rebound again, crypto will rebound even more. I think that's the key thing.
And do you think then that's a good buy now, then, would you say?
Um, I wouldn't be piling in now, right? So there's an expression, in the markets, catching a falling knife. So I don't want to be catching that falling knife. I'd rather be catching other falling knives.
So many knives to choose from, so few haven't managed. That's the problem. That's the problem.
Well, there was one pick last time which didn't turn out to fall. Which
Let's imagine whose that was, Rod. Let's try and think.
You guessed it. It was me with Ramble Global Equity, which is actually up, even based on the last 48 hours, up by 8%. So, yeah, not
Wow,
done too
amazing.
bad. Yeah. But let's see what happens. Like we said, we seem to be okay at picking the time to buy. It's picking the time to sell, which is
So would
always.
you be buying more of that, Rod, or selling at this point, or?
I'm with that. I think last time I spoke about it, it's something that I pound cost average into. Um, because it is an active fund, and I think their holding period on average is about 6 months. So they take the gains and then they kind of get out. And I think they had sort of Nvidia sort of 5 years ago, and they took their gains and got out, and they said, "Well, we don't regret it. That's our model. That's what we do." So that's kind of where I'm at. So yeah, I might put some more money in, but I'm sure we'll get on to our picks now and what we're all looking at. So, does anyone want to volunteer for going first?
I don't mind going if you like, because I don't normally go first, so I'm happy to.
Go for it,
Um,
Adam. Yeah.
Especially as we've already mentioned him today, and falling knives is the thought. And the problem in many ways is this is not really a falling knife. But I do remember I'm kicking myself, to be honest, because it's probably about 12 or 15 months ago, maybe 18 months, when I read an article saying basically if you broke down the individual component parts of Berkshire Hathaway, it would be worth much more than it was worth today. And it was, from memory, it was trading at sort of around the sort of 700 billion market cap at the time. And now, of course, it's 1.2 trillion. So it's up significantly since then. But the specific reasoning for today and this particular market for putting some more faith in Uncle Warren, because no one plays these situations better than he does, is that I think however this plays out, and we just don't know, do we? Because tomorrow could be another day. There could be a deal. There will be deals being done while we're recording this, let alone when we release it. But I think if I was going to pick a man to navigate through those choppy seas over the coming days, weeks, and months, because the other thing that sprang to my mind when Donald started his rambling speech the other night about tariffs was he was presenting himself as this kind man who was only doing half of what other people were doing to the US. The other thing my brain thought was, well, hang on, soon he'll then want to equalise it, and then maybe he'll double it. Because, remember when I halved it and I was being kind to you? Well, now I'm not being kind and I'm doubling it. So there's no real lid to some of these tariffs. I don't think he could easily be doing 125% on China or all sorts of stuff before he's done. I wonder what percentage of what he wants he'll actually get. So the bet, if you like, is the volatility to continue. In a way, it's kind of a bet that the VIX will stay high, I guess, because Berkshire Hathaway is such an institution now. It's turning into the place where people run when they're scared. And I think, gold is at a punchy level now. We've discussed gold before. I noticed Rod hasn't included that in his summary of today's events, but never mind. But I know we're going to talk about it a little bit more today. But I think the flight to safety in Berkshire Hathaway B shares, of course, because you don't get to vote at Berkshire Hathaway. You just get to enjoy in the returns. And I think apart from the demise of the great man when he does go, and we hope he's got many years left on the planet yet, of course, it probably still feels like a pretty good time to buy into Berkshire Hathaway, I think. So that's my overarching, it's my safety stock pick for the week of the falling knives, or whatever you want to call it.
So Adam, my concerns about that pick would just be really how well it's doing, and it's like if it's at its kind of record price now. It's gone up a lot over the past 18 months, as you've said. So that's always a bit of a concern for me. Is are you buying it right at the top because everyone else is putting their money in there too? And the other thing is that obviously Berkshire's big on American stocks, and are we worried now about American stocks over the next few years because of these tariffs, and because actually that might be a concern? What are your?
So two good points. Let me address the second one first. And I think the sort of American companies that they own, I think no, probably not, because what does the Donald want to achieve from all of this, right? He'd like to get people locating factories in the US. He wants to unwind globalization, which is not, look, apart from the economic harm, this was kind of, we had these sort of discussions during and after COVID, didn't we? It wasn't the same world anymore. So there's a security concern. We didn't talk about energy security in the UK at all before 2022, did we? I don't remember talking about it in the 2010s at all. We talked about renewables, but not with the reason of generating our own power. So I think America, good old fashioned American stuff that is, crosses generations, whether that be Heinz, whether that be Coca-Cola, whatever, I would expect they will do okay because imported, especially if it's coming across from the EU, and of course that all depends on how that chess game or this sort of 4D chess game is going to play out. But I think they will do okay because you're a couple of years away from really meaningful moves of people reshoring production in the USA. And I think you're going to struggle to get boards of directors to agree to putting big money into big strategic moves when I say these words advisedly. Donald's only got 3.75 years left. We know that some things could potentially happen, but under the Constitution, which is not slated for a change and is not going to be changed under the current laws of the US, who knows what the next president might do. So it doesn't feel like you can make big strategic decisions that would have, 15 or 20-year payback implications. If you were Rolls-Royce, can you really recite too much in the USA? I could understand you having a factory there for strategic purposes, but you and I both know that's not going to be built particularly quickly, and that doesn't affect the price of tomato soup and Big Macs or whatever anyway. So I think there's quite a safe reason to do all of that because it's the comparative difference in pricing of American goods versus other goods. So whether it work, look, I think we all know it's not going to work in the way that whatever Mickey Mouse way Donald Trump thinks it does work, right? But I think it will favour some of the homegrown stuff quite considerably. And I think there will be a big push because I think in the EU you're going to see a lot of, I think the Swiss being quite Swiss about the whole thing. Who remember they never speak, right? They stay out of every war there ever is, and they handle money. That's what they do. But they've said, well, look, the response is buy Swiss chocolate in Switzerland. That's the response, right? So I think the nationalistic wave of buying American goods, I think favours Berkshire here quite considerably. The first point you made, I've now forgotten what you said because I've banged on for too long. So sorry, you'll have to say it again.
So the first point was just essentially what you kind of had mentioned before, which was you're buying it at the top of the market.
Oh yeah. Look, can't really deny that. I think my only defence or attempted defence to that is it was cheap before, and now just because it perhaps is approaching fair value, I don't think we're buying above fair value, and I think there's a considerable amount of upside protection from where we're going over. And there was a number of choices, but I also looked at the way. I know I jumped first in our picks this time round, but I thought I was thinking along similar lines to you guys, and also thinking about, because this is not investment advice, as you say, Rod, it's a bit of fun and a discussion. It was probably the thing I wanted to discuss the most at this time, given what's going on.
Brilliant. Manish, any comments?
Yeah, look, it's Berkshire Hathaway. I would own it forever, or as long as Warren Buffett's in charge. I mean, look, it's hard to say, it's hard to push back. The only thing I would have said on Berkshire Hathaway is what you've just said, Rod. It's quite US centric, and I've been so most of this year I've been really sort of banging the drum about people being too focused in the S&P in the US. And for various different reasons, not necessarily tariff, but tech and the dominance of tech and what's going on there. So I've been really encouraging people to be more globally balanced and diversified, not just equities and gold and bonds and etc. So that's the only kind of potential pushback on Berkshire Hathaway. It's got a large percentage in cash, and he's been really opportunistic. Warren Buffett, he's almost got a sixth sense for seeing what's around the corner, and he's played this really well. So I think you've got to have a bit of Berkshire Hathaway in your portfolio. Absolutely, I think that's a really good pick, Adam.
Thank you, appreciate it, and good comments from both as always.
Manish, do you want to go next, or do you want me to go?
Yeah, I'll just talk about mine. I probably won't take too long. It's gold. It's pretty simple, and everything that's going on right now, it favors gold. It favors a flight to safety because I think all of these conversations about tariffs and negotiations will get drawn out, right? And we've got another 4 years of this president. So who knows what else he's going to announce? I think gold kind of plays into that for two reasons. One is it's a flight to safety. People will jump onto that. Number two, whenever gold has historically, we have to remember gold can be dead money for years and decades, right? So there's been, plenty of periods of time, 10, 20, 25 years, where gold has just done nothing. So we have to bear that in mind. But when it does do well, it does really well. So that momentum continues. And the third thing is what we're seeing right now, which is really interesting. During a period of uncertainty, what you usually get is a flight to the dollar, right? The dollar tends to go up during periods like this. But interestingly, the dollar is being sold off right now. And what that's reflecting is that, so for so many years, people have seen the US as the only game in town, tech as the only game in town. And now there's a big rotation going from US into Europe, into Asia, into other asset classes. And that plays into gold, and that's one of the reasons why gold has been doing well, because there is an inverse correlation. When the dollar goes down, gold goes up, and etc. So gold. I think there is a possibility that the dollar will continue to decline, given all of those huge inflows that we've seen until now. So the gold. Return on gold, I think, will continue as a safe haven, as a play on the dollar, and as a play on lower bond yields, which we're already seeing. How do you play it? So you can buy ETFs. I don't like buying physical gold. ETFs are the most efficient way to buy gold, and I'm also doing it through options. So I'm owning gold, but also earning 1 to 2% per month on gold, and so for me that's a bit of a no-brainer. There's also a strategy, which I won't go into a huge amount of detail. It's called the poor man's covered call, which enables you to buy gold at sort of 20% of the cost, or rather gain control of gold at 20% of the original cost. And that's a really interesting way to play it as well. So yeah, it's gold is my pick for this time.
Brilliant. Again, my concern is similar to the one with Berkshire in that gold's been ramping up in terms of price over the whole year, and it's kind of at all-time highs now.
Mm-hmm.
Do you still see runway in that? I mean, where do you see it getting to, and what kind of time horizon as well?
Yeah, so if I look back at the historical sort of patterns that gold makes, when it does well, it tends to continue to do well for a decent period of time. So gold is, it started doing well around the beginning of 2024 or the late part of 2023. It's only really since then. And if you look historically, we've had years and years and years of gold outperformance. So I don't think that should be a big concern. It is becoming a bit of a consensus trade, kind of, but still, equities, there's still a lot of money in tech and Magnificent Seven, etc., which is still a very crowded trade, I think. So yeah, I'm not too worried about the fact that gold is reaching record highs. I think that will just continue.
Right, Adam?
Yeah, I mean, obviously that is the seminal point, I think, Rod. But I mean, trying to pick the high is tough, isn't it? Because we've heard cases for years for $5,000 gold and stuff. For example, it has outperformed. It can't continue. But stocks outperformed. Big tech certainly outperformed. Really outperformed for the thick end of 15 years, really, after the financial crisis. Apart from anything else. Not that it did too badly the 10 years before that, but it was at least nascent in that point in time. The only thing I would say is probably I would kind of prefer if there'd been a 3 or 4% pullback or something that was in line with the rest of the market, and Manish was then saying, look, I'm topping up a position because I think there's more to go here, and there's been a little bit of a blow off. When there are runs like this, there will be significant downtrends, mini downtrends probably. And I'm with him. I do think the bull trend will continue, but that we are at a point where there's been significant outperformance. But do you see the dollar strengthening again anytime in the near future? Not at the moment. I don't know how many times Donald Trump can spook things, and regardless of how much you politically support him or not, I don't think the markets really care. But there'll be a lot of people sitting with money in physical assets, cash slash gold, and now bonds are taking a bit of a bath. There's not as much return in holding short-term paper either, is there? So I would like to know, Manish, you are the man to ask this question, I think. Do you know, or is there a way of finding out how much is sort of retail slash public money versus institutional slash long term big money betting on gold at any one time? Is that something you can calculate? And if you can, what does it look like at the moment versus normal?
That's a really good question, Adam. It's harder to calculate because typically retail individuals, they don't just buy gold ETFs and sort of exchange traded gold. They would buy gold jewelry and retail gold, etc. So that stuff is really hard to figure out. I think it's been increasing. I'd say it's been increasing. Gold inflows have been increasing both from institutions and individuals. So both levels have been increasing. I don't know the percentage share, but what I do know is that a lot of the foreign central banks, when I say foreign, I'm talking about non-US central banks, have been really piling up gold reserves, in Asia in particular. So, that pocket of ownership has grown massively, I would say. So I'll try and find out, actually. It's a really good question. I don't know the answer. I suspect it has been growing, but I don't know to what level. Just the final thing I'd say on gold, which I think it's a really important point to make, is that yes, we buy gold to get the upside, but usually, and right now it happens to be doing really well, but usually I think gold is a really good thing to have in your portfolio as an insurance policy. Because when we've got risk assets, whether it's equities, property, or whatever, gold tends to do really well when there's something bad going on in the world. So I like the idea of having a sort of sleep at night bit of my portfolio, which I know is going to do well when there's something bad happening. So yeah, as an insurance play as well.
Yeah, great comment.
So we're both hiding in different ways, is what you're saying, Manish. Yeah.
Exactly. Exactly. I think this is the time to hide, possibly.
Yeah.
Whereas I am not. So with my pick, it's a global uranium ETF with the ticker URNG. Now, I've been kind of looking at uranium for a while, thinking that with all the stuff about energy and things like that, just thinking that that is a really bullish kind of case for uranium. We keep talking about nuclear reactors and all these things, and all over the world they're looking at doing more. And weirdly, and I can't really work out why, over about the last 5 months, it's been pretty consistently dropping. And I, for the life of me, don't really understand the reasoning behind that because I think I mean, at the moment it's priced at about £9, which is its lowest year to date, or in the last 12 months, sorry. And I mean, that's dropped from about £15. So it's a pretty hefty kind of drop to where it was a year ago. And I kind of think there's so many things moving in the direction of nuclear. All kind of energy. We're all kind of every country, and even with the Trump tariffs, it expands that need for individual countries to be energy. What's the word? Kind of not reliant on others for energy, so energy security and things like that. So I'm quite bullish on this, certainly for the sort of medium term. And I just think I'm kind of pound cost averaging my way into it at the moment because it does seem it's been dropping for a while, and I just can't. I'm thinking it's at some point it's got to go up because everything seems to favour it.
I think the demand factors are positive, as you said, Rod. I think what is the wild card is the supply, right? So I think from the supply perspective, um, you know, uh, there's been an increase of supply, and I think there is some uncertainty as to who is going to be increasing supply and where that's going to come from. And so with any commodity price, it's always demand and supply. So the demand factors, I can't argue with those, but the supply is the sort of wild card here, I think.
I've listened to a ton of stuff about uranium, Rod, and come to a similar conclusion as you in terms of medium term safety in numbers there. But the, without diving into yellow cakes and HALEU fuel and all sorts of very technical stuff about uranium and small modular reactors and all the rest of it, I think the problem might be it might just take quite a long time to play out. It is difficult and strange watching it drop in the way that it has done. But then drawing the parallels with Manish's pick, gold miners have not had the good time that gold has done in the past. I mean, gold's up, what is it now, Manish? 45, 50% on this current run. If you went back to when you were talking about
Glenhawk, which was one of my previous picks, is down about 40% in that time.
Exactly. So understanding the parallels between the two is sometimes difficult. And what the real, application time online for small modular nuclear, wherever it comes, because to sensible people, I think it seems like the answer in a net zero world. It makes loads and loads of sense, and we've got to get over. It strikes me that we spent 40 or 50 years worrying about things that didn't really happen very often. And even when there were meltdowns, it was still an incredibly safe fuel, and things are a lot safer now than they were. Uranium's a bit like, or nuclear is a bit like aircraft. When there's a mistake, they learned a lot from it, rather than medicine, whereby when there's a mistake, you try and cover it up, and it probably happens again and again and again, sort of thing. So I like it. It's just time invariant, really, and at least you're buying on the back. Other than the very valid criticism that you raised a couple of times, you're not buying in the middle of a bull run here, right? But it's the thing that's nagging in my head, Rod, is that bit of info which I've always found useful, which when the market doesn't do what you think it's going to do and you can't explain it, the market can stay irrational longer than you can stay solvent, and it's a very strong signal when it should be going up and it's actually going down, and that's what concerns me with the pick, I think.
Yeah. Manish.
Yeah, I think I'm more confident on the demand than the supply. So on the demand side, yes, subject to everything Adam said, which is all sensible. I think on the supply side, it's really hard to know how that's going to work out, right? So if all of that additional demand that we expect over the coming years, decades, is going to be met by additional supply, then all we're going to get is the prices aren't going to move, right? Because the pricing of commodities is very simple. It's just supply versus demand. So that's the sort of unknown for me. I don't have any visibility on the supply of commodities. I don't think many people do, right? I mean, the miners and and typically these uranium mines are located in places where you don't get a huge amount of transparency. So that's the sort of big unknown for me.
There's a fair bit of conversion that goes on in Canada, isn't there, as well? So, I mean, I don't know. It wouldn't be tariffed, would it? Or, I mean, I suppose everything's on the table at the moment, but there could be an angle there as well.
I think that's a really good point about demand and supply. And to be honest, it's something I've always been focusing on the demand, and which is silly, really, when you think about it. But yeah, like you said, it's hard to find out where that comes from, but it's certainly something I'll take a look at. I just think for that kind of medium term, while everything is dropping, and this has been dropping for a while, I just think kind of it's all the things that seem to be there for that demand side, but what's going on with the supply, and is it that's the thing holding it back, or is it something else? And if so, what are we not seeing? So that they're certainly the questions that that I'm in. Yeah.
I think the other way to play uranium, and if you like the whole sort of nuclear theme, is is to kind of look at who sort of does the sort of manufacturing of the plants and the machinery and the components and all of that sort of thing. If there are any pure plays
Mhm.
of nuclear power equipment, that might be a more sort of demand-driven way to play it.
Yeah,
That's
I
an
think that's a good
interesting.
point.
Yeah.
And,
Yeah.
and the ETF, I think, does cover a few of those sort of companies as well.
Mm.
It's not just kind of miners. But yeah, I think that's a very, very good point.
There's a hefty smattering of startups, some of which back billionaire backed and all the rest of it, because it's in the same sort of way that you're speaking there, Rod. I think they know it's happening. When it's happening, who knows? It's a long project.
Yeah.
Put your faith into someone. When there's a breakthrough, all the money in the world will be unlocked for it. Let's face it. So there'll be a thousand bagger in a portfolio of startups. You just don't know which one it'll be necessarily.
No, for sure. Brilliant. Well, we are at the end of our session, so I'm looking forward to seeing how we've all done in 3 months' time. But like we said, it's not just about kind of when you pick it; it's about when you get out as well, which makes all the difference. So I think, yeah, it's always interesting to hear from you guys how long you're expecting to hold something as well. So do you just want to quickly run through that? Is this, I mean, we've mentioned Berkshire Hathaway holding it forever. Is gold one of those things? And what are you looking for in terms of, I guess, fair value, really? Or is there a point at which you go, yeah, I've had enough out of that. Let's take my winnings and go on to the next one.
Yeah, I think gold for me is more like a permanent thing, right? So I have it in my portfolio. Insurance, I just kind of have that just to sit there. Fair value, it's really difficult, and a lot will depend on how this whole Trump tariff thing plays out, and whether it escalates or not, whether we have a recession or not. Yeah, if I was to have a stab at fair value, and remember, gold doesn't pay income, so you can't really
I know.
provide a proper sort of fair value estimate. Um, yeah, look, I'd say, somewhere between 3.5 to 4 is something where I'd be looking to say, okay, well, that's interesting, good level, got some profits. Let's think
And
about
what
what to do next.
and what percentage of your portfolio would you be comfortable having in
Mm,
that at the moment? Because I'm guessing that's the bit that probably changes, is
yeah.
how much of your portfolio at what sort of time do you want?
Yeah, yeah, that's a really good question. So for me personally, it's been around 10% so far. I'm looking to kind of increase that to around 50, somewhere between 15 to 20, just because the level of uncertainty is something. And look, it's not like dead money. It's making money, but I'm also getting gains from income from the sort of option side of it. So I think that it's working really well from that point of view. So yeah. 15 to 20% is where I'd be looking to put it up to.
Right. And Adam, how about you with Berkshire? Are you in it for the long haul, or is there a
Yeah,
point?
I mean, I think there's a good reason to be in it for the long haul. But again, using your point in terms of rebalancing, I think if there was significant outperformance because, for example, that big pile of cash gets deployed into a clever loan note warrant, something convertible. One of the big companies has to come to warrant cap in hand, sort of thing, and there's a big deal done. You might see quite a decent fair value adjustment, and that might be time to trim the position. So if you wanted a target, I'd say if the market cap went up to more like 1.5 trillion within a relatively short time frame, so let's say the next 12 months to put a time frame on it, I'd be comfortable certainly taking some profit or halving the size of the position or something like that.
Great, brilliant, great conversation as always, guys. Thank you so much, and I look forward to catching up with both of you next quarter.
Thanks, guys. Cheers,
Good
Rob.
job, everyone. Thanks, Rod. Thanks, Manish.
Cheers, Adam. All right.